Assalamu alaikum wa rahmatullahi wa barakatuh. How are you, my dear brothers and sisters? I wish you all health, full health, and be protected, and all of your family from this disease, inshallah. Okay, so our topic today is about materiality and risk, or audit risk. So we will discuss it in details. We will see materiality. For sure, we know what is materiality. We discussed the materiality concept and term and how it's linked to the auditing. And we will discuss it again. We will try to highlight again the materiality, the factor that affect the materiality, and also we will discuss the process of operationalize the materiality into the auditing process. Then after that we will discuss the audit risk, and we will discuss the type of audit risk, and we will discuss also the audit risk model. So the first objective for this topic is applying the concept of materiality to audit. So if we can recall, in chapter 1 we discussed the fundamental concept in auditing, and we discussed the breakdown of the phases in auditing. The first one is engagement, understanding the client, and then set up the materiality and audit risk, planning, test of control, audit, test and substantive, then complete the auditing, and then issuing the audit report. So today topic is focusing in the materiality and set up the materiality and the audit risk and evidence. So what is the main objective for auditing? If we can recall from the definition that we repeat in the previous classes, the main objective is to provide a reasonable assurance that the financial statements are free from materially misstated. So we are focusing only in the material misstatement, not the immaterial. So how do we define the material? So according to the ISA 320, paragraph 3, materiality is the magnitude of omission or misstatement of accounting information that could influence the economic decision taken by users of financial statement. So if we analyze and break down this definition, we can see that it's about the volume or the amount of misstatement on the accounting information which will influence the economic decision by the users. So to be material, it should have influenced into the decision makers. So material means significant, important, and it should has magnitude of amount, accounting amount that mislead the. So by analyzing the definition of materiality based on ISA 320, we can say that it is about magnitude of amount. So when we say magnitude, it means large amount about information, accounting information or economic information that may influence the economic decision, means it is important. This information is very important and it's significant to lead to influence or diverse the decision making process by the users. So to summarize, information equal to material, and this lead to could influence the decision of financial statement users. And this one is the materiality is very judgmental, subjective. It's not fixed or absolute amount. it is based on the professional judgment by the auditor, and it is providing a threshold or cut-off point that the auditor can compare the estimated or the result of auditing test, if there is any misstatement, and to compare whether it is equal or more than this cut-off or threshold. We should know that materiality is a major consideration in determining the appropriate audit report. This means that the materiality or setting the materiality will affect the auditing process as well as the completing of the auditing process, as well the issuing audit report. Because when we set up the materiality, we set up the materiality in the level of the planning stage, which is the pre-auditing test. Means it will affect all the following steps on the auditing. So we need to ensure that we consider we do it in a very proper manner. In this example, we will try to simplify the concept of materiality, what we mean by materiality in practice, and we will try to link it to the sample size. So let's say we put the materiality threshold equal to 5,000. So we can see here we have three amount is equal or more than 5,000. So those amount will be the target sample for sample size for the auditing process. So if we put the materiality threshold is in 3,000 level, so we will include more transactions to be included in this in the sample size. If we put it more or less, set up the materiality threshold less, let's say we put it in level in 2,000, so we will have more transaction to be included. So the more the materiality, the less the more the materiality, the less the sample size, or the smaller the sample size, or other word, the less the materiality means the more the sample size, which means there is a inverse relationship between materiality and sample size. And yeah, we can say that we need to better to have bigger sample size, but we need to consider the cost, because the more sample, the more transaction, the more effort we do, the more team we need, and the more time we need to conduct the auditing. So we need to consider the cost and the timing frame. This is another example just to explain how we operationalize the materiality level within the each account. So in this example, we have in this basket we have 1 million of transaction, and we have different amount of individual transaction. And if we set up the materiality threshold in 50,000, we will have only those transactions which are above than the 50,000. The rest will be considered as immaterial transactions to be not considered. In here, just to show that there are some auditing software that may help to determine the sample interval based on key in some data like the population value, and also set up the risk, the acceptable risk, set up the reliability factors, and so on, and also determine the tolerable misstatement, which is the breakdown of the materiality. This one will help to calculate the appropriate sample size. After we discuss the materiality definition, and let's say what is the responsibility of the auditor toward the materiality level. So the auditor responsibility is to determine whether the financial statement are materially misstated or not. If the auditor find any material misstatement, the auditor responsible to bring this material misstatement into the client attention so they can correct it. If they refuse, then the auditor will go to start to shape their audit report according to the situation. Before we go on in the determining the explaining the materiality or the preliminary judgment, the step one, let's explain the three factors that affecting the judgment of determining or setting the preliminary judgment. So we need to bear in mind that materiality is relative rather than absolute concept, means we cannot set up the same amount for materiality in for all for different size and type of companies. So what is material misstatement in small companies, it may be immaterial misstatement for larger companies. Okay, so next, the basis. What is the basis that we determine our materiality? Net income before tax is normally the most common basis used, but not necessary to be acceptable or applicable to all companies, because if the company occurred loss, so we cannot use net income before tax. Better we use revenue, net revenue. So that's kind of different basis. We should determine the basis and also determine what is equivalent, what is applicable to the company. So as we said, net income before tax is normally the most basis used, but other possible bases include the current assets, total asset, current liabilities, and owner's equity can be used as well. Other than that, the third factors is qualitative factors also affect the materiality. What do we mean by qualitative factors? So materiality is a dollar or ringgit concept. We need to set up a ringgit concept of materiality. However, some non-financial information that can be considered, let's say the stock market pressure and the management bonuses, loan, slight loss, and slight profit. So if the company have slight loss or slight move to slight profit, then the auditor, this is auditors should consider this as a qualitative non-financial information can be affecting the materiality. The management bonuses, if the management bonuses have a scheme of management bonus and compensation, so let's say if they have the profit of 1 million, the bonus will be 5%. But if they have more than 5,000, more than 1 million, 1 million to 2 million will be 10% of bonuses, then the auditor should consider that there is a considerable material misstatement to play or overstate the reported earning in the financial statement to the interest of the management. Okay, so that's the three factors should be considered. The guideline, let's say the guideline, accounting and auditing standards do not provide any specific material guidelines to practitioners. Means the auditor cannot rely on the accounting and auditing standards and regulation about the setting up the materiality or the preliminary judgment. Professional judgment is to be used at all times in setting and applying material guidelines. Here we will discuss the steps in applying materiality. We have two steps in the planning stage. So if you see here, we are in the planning stage, means in the early before we conduct the auditing and test of auditing. So in here we will need to first we need to set up the preliminary judgment, which we discussed in the early slide, that the preliminary judgment is the materiality threshold in the level of financial statement. Then in the step 2, we need to break down the preliminary judgment into the segment. So we need to break down the preliminary judgment into the segment. So in the step 3, 4, and 5, it's not in the planning, it is while evaluating the result. So the step 3, we will estimate the total misstatement in each segment. So we need to get the figures of the material of the misstatements in each segment. And then step 4, we need to combine all this tolerable misstatement, we will call it tolerable misstatement, to get the total tolerable misstatement, and then we compare it with the estimate the preliminary judgment that we set up in level in step 4. Okay, let me simplify this to simplify the 5 steps. So step 1, we will set up the preliminary judgment. Step 2, we will break it down into tolerable misstatement to each account, to each segment of the account. So this is planning. We're still in planning stage. Okay, and then step 3, while we are processing, looking for the misstatement in the segment. So any amount that misstatement that we found is equal or more than tolerable misstatement, we will collect it, estimate it. Then after that we will accumulate. Step 4, we will have accumulate or get this total amount, total of this tolerable misstatement. So we call it total tolerable misstatement. And then step 5, we will have the comparing between tolerable misstatement, compare the total tolerable misstatement with the preliminary judgment, this one. We will have in details the explanation after a while, but what I would like to explain here to show you how you link those 5 steps. It's quite simple. It's about having setting up the preliminary judgment in the financial statement level. Then we break it down into tolerable misstatement in the segment account level. Then we try in step 3, we try to find out the misstatement in the segment level, and we check if it is equal or more than tolerable misstatement. And then step 4, we combine those tolerable misstatements, and then we compare the combined tolerable misstatement with the preliminary judgment set up in step 1. Okay, so let's go one by one and we discuss in let's say the first step, which is set up the preliminary judgment about the materiality. So step 1 is to establish preliminary judgment about the materiality. First, let's define what is the preliminary judgment. Preliminary judgment is the maximum amount by which the auditor believes that the statement could be misstated. Means the financial statement have material misstatement within its figures. So, but and still not affect the decision of reasonable users. Means it's not clear, or it's not influencing the decision makers of the financial statement. In step 1, in determining or setting up the preliminary judgment, we will need to consider two aspects. One is the quantitative and the qualitative. In the quantitative side, we need to set up a percentage for each of the accounting figures in the financial statement. So, for example, 5% for gross profit after depreciation, 3 to 5% of profit before tax, and 0.5% of revenue, sales, total assets and equity, and so on. To illustrate more, let's say this example. So in this example, we have total assets for one of the company is 10 million RM, and we set up the preliminary judgment to be 5% of total assets. So we will calculate the preliminary judgment to have the 500 as preliminary material judgment. So if the total assets misstatement found in the process of auditing less than 500,000, it will be immaterial. If it is equal or more, then the auditor will consider it material misstatement. Okay, the next side, or the other side, we will have the qualitative aspect. The qualitative aspect, we means that there is some aspect may affect that preliminary judgment, the quantitative preliminary judgment that we determine based on the financial statements figures and percentage. One of this aspect is the nature of business operation. Next is the size of the company and the volume of business transaction, and also prior client history. This one we call it qualitative. So let's say in the example, we see in the example that we have the 500,000 as preliminary judgment. However, due to the client history and riskiness of the industry, the company is deemed to be riskier than the norm. Because of some situation, or this year, let's say we have the coronavirus in this situation. So we need to consider the industry or the business environment to be more risky. So we need to consider that this situation to affect the total amount of preliminary judgment has been set for total assets. So we may reduce it according to the auditor professional judgment. So now we finish sitting discussing the materiality and define it. We discussed what is the factor that affect the preliminary the judgment, professional judgment by in setting the materiality, and then we discussed the 5 steps in general. We discuss also the step 1, and we explain how we determine and set up the preliminary judgment in the level of financial statement. And we discuss that we need to consider qualitative aspect and quantitative aspect in the process of setting the preliminary judgment. Now, the next step is to allocate the preliminary materiality to the segment of the auditing during the planning. And this one will be discussed in detail in another video to ensure that the length of the video not exceeding half an hour. Okay, thank you. We'll see you in the next video. Assalamu alaikum.